Hey traders, welcome back to this channel. Igor here, MrToptic.com. If you're new to this channel, please consider subscribing. There's also a link in the description where you can enter your name and your email address for a chance to win 30-day access to either Income Navigator or Active Trader Pro. Those are our trade alert services. Today I want to talk about a strategy that I call a bear trap. This trade also has several other names. Some refer to it as 112 or 113, depending on how you structured the trade. I'm going to go back and walk through all of the steps that I took and how I arrived at the final number. So since the beginning of this trade was initiated on August 31st. S&P was trading right around 39.55. I initiated a bear trap, which consists of two parts. There is a put debit spread and there is an out of the money naked puts. Now, trades that involve selling out of the money options naked carry a ton of risk. They also pretty intense on buying power or margin. And I don't recommend selling options naked unless you truly understand the risks associated with it. So that is something that everyone should keep in mind. I've also posted a similar trade setup. This is another variation of a bear trap, and I'll include a link where instead of selling out of the money naked options, there is an out of the money put credit spread. So the risk on the downside is capped. On August 31st, I initiated a bear trap. I bought a put spread. This is a 30-point wide put debit spread, and I sold an out of the money puts at 33.50. Now, the way this trade is set up is whatever I pay for the put debit spread, I want to sell out of the money puts, and the number of puts will be dependent on what I paid for my put debit spread. So let's say if I spend $5,000 on this put debit spread, I need to sell at least $5,000 worth of out of the money puts naked in order to compensate or cover the cost of my long put debit spread. What I did different here is that I not only bought a put debit spread, I also had one extra long put. We can look at the chart, and this is S&P back on August 31st. We have price coming back down. We are breaking underneath the 50-day moving average. My thinking was that we were going to come down and retest maybe around 3,700 on the S&P. So therefore, I set up a trade that would benefit from a slight pullback somewhere in the area of 3,800 down to about 3,700. Now, clearly we can tell that if we're going to get a flush down to 3,700 the same day or the next day, this trade isn't going to benefit right away, but over time, right, this is my T+0 at expiration. Over time, my T+0 line, which is currently pointing downwards at around 3,700, but at expiration, it's going to be all the way up here, and I'm going to make a profit somewhere around $20,000. But there are 37 days until expiration, so I'm going to step through all adjustments that I did following into this trade. So now we'll look at this same trade 19 days later. SPX moved minus 0.7 standard deviations. IV increased by about 30%. What I did was I closed two of the long put debit spreads, and I collected $9.75 or $1,950 in total. So now this increased my credit that I had collected here to about $3,450 or so, which means that if SPX expires above my long put at $37.80, I'm going to get to keep the $3,440. So now we go forward a couple of more days. This is 21 days in this trade. We can see that S&P is down about a half of one standard deviation from the time when I entered this trade. S&P is trading at around 38.80 or about 100 points away from my long put debit spread. With 16 days to go, I decided to close one of the remaining put debit spreads. I collected $8 credit or $800. My total credit here is $4,255, and I was to keep this credit as long as SPX closes above 37.80 at expiration over the next 16 days. So now we go a few more days into this trade. This is September 26th. S&P was at around 36.70. and my put debit spread went in the money. Now, in 26 days, SPX moved minus 1.35 standard deviations, and volatility has increased about 40%. So what I did here is I went ahead and I closed one more put spread. I collected $19.20 or $1,920, making my total credit that I had collected $6,175. I was going to keep this credit if SPX went back above 37.80 at expiration. Now, since SPX went inside the bear trap, right? This is the bear trap. This is where this trade makes the bonus. My put debit spread is in the money, and as long as SPX is below the short put of my put debit spread, this spread will be worth the width of the spread, meaning this spread is 30 points wide, and the most this spread can be worth is 30 points or $3,000 each. I also had an extra long put with this put spread, which is going to juice up the profits a little bit, depending on where SPX is going to expire. So now we move forward. This is 28 days in the trade. This is September 28th. We had a pretty strong day. S&P was up 70 handles. We're up 1.23 standard deviations on the day. And it looks like the bear is going to leave the trap, right? So what I did was I closed out the put debit spread with the extra long put, and I bought a put which was 10 points above my short naked put, converting it into a 10-point wide put debit spread. I had locked in about $13,551 profit and left the potential for more profit if SPX was to expire below 33.50 over the next 9 days. So this is what this trade looked like before making the adjustment. I had two longs at 37.80. I had a short put at 37.50, which are now in the money. And then I had 10 short 33.50s. So what I did was I closed out the long 37.80. I closed out the short 37.50. So this was taken off for a profit. And what I also did, I had bought a put 10 points above my short put. I bought 10 puts at 33.60, making this into a put debit spread. And this is what this trade looked like after making this adjustment. Now, I had locked in $13,551 profit, which means that if SPX remains underneath 33.65, I get to keep $13,551. And if SPX continues lower over the next 8 days or 9 days, if at expiration SPX is below 33.50, I have a potential to make an additional $10,000 profit, making this trade a total profit of $23,551 or so. So now we go to today, September 29th. SPX is currently trading at 36.15. We not only gave up all of yesterday's gain. Yesterday, S&P was up 70 handles. Today, we're down about 100. And I see an opportunity to possibly take a little bit more profit out of this trade, right? I had 10 of the put debit spreads at 33.60, 33.50. So what I did was I closed 6 of the 10 put spreads, and I collected 80 cents for each, taking in an additional $480. So as it stands right now, this trade has 8 days until expiration. S&P could fall below 33.50, and this trade could potentially make an additional $4,000. If SPX remains above 33.60, which is where my long puts are, I just get to keep whatever I had collected in this trade, which is $14,026. So this is one of the examples of our bear trap variation that we trade in the Income Navigator. If you enjoyed this video, please consider subscribing to our channel, liking this video, leave a comment with your thoughts about this trade. And as always, if you take care of the risk, the profits will take care of themselves.